Last week, gold and silver did something they have done only a handful of times in history. Not during a crisis, not during panic, not when markets were collapsing, but precisely when everything appeared completely normal. Gold broke through levels that many analysts refer to as cycle peaks. Silver rose in a way that, if you look back across decades of data, almost never happens during an ordinary trading week. There was no panic, no rush of money fleeing equities, no headlines warning that the financial system was breaking. And that is exactly what makes this move unsettling, because historically, gold and silver tend to move like this only when something is being forced to reprice. Not because people are afraid, but because the system itself can no longer keep everything frozen as it was. The difference this time is that the system still appears to be running smoothly. Banks are still open. Stock markets remain near their highs. Technology continues to be praised as the solution to every problem. If you only look at the surface, there is no reason for gold and silver to be behaving the way they are. And that is precisely the problem. The most dangerous periods in monetary history rarely begin with sirens. They begin when defensive measures quietly change their behavior, while most people still believe that nothing is happening. When the prices of assets that do not depend on anyone's promise begin to move faster than the official narrative can explain. You can call this a rally. You can also call it speculation. But if you look more closely, there is another, far more uncomfortable possibility. This is not a story about gold and silver. It is a story about a system beginning to reveal its own misalignment at the very moment it appears most stable. If there is no crisis, if there is no panic, if everything still seems fine, then what is forcing gold and silver to speak up right now? Before going any further, one important thing needs to be clarified, because without it, this entire story is easy to misunderstand. This is not a video about how many more percentage points gold and silver are about to rise, nor is it a call for rushed action. What is happening here does not begin with prices. It begins with structure. Gold and silver in this story are not the main characters. They are neither the cause nor the solution. They are simply measuring tools. Just as a thermometer does not cause a fever, gold does not create instability. It merely reflects the degree of distortion between economic reality and the story the system is telling us. In other words, gold does not predict collapse. It measures distortion. And once you understand that, you begin to see market signals in a completely different way. There is a very common assumption whenever markets exhibit movements that are difficult to explain. It is this: someone must be hiding something. The media is covering it up. Banks are manipulating it. There is a conspiracy behind the curtain. But reality is usually far less dramatic. In most major cycles of financial history, no one needs to hide anything. The important data is always there. Public, accessible, even reported regularly. The problem is not that information is being concealed. The problem is that we are trained to ignore it. The modern financial system does not operate by lying to you every day. It operates by directing your attention toward things that are familiar and easy to understand. Stock prices, growth headlines, GDP figures, stories about technological innovation. Those things are not wrong. But they are not the whole picture. And more importantly, they are not where structural distortions first begin to show. When people look at gold and silver, the first question is usually, why are prices going up? That question sounds reasonable, but it already assumes that price is the center of the story. In reality, price is only the outcome. The more important question is, what is making traditional metrics less reliable? Most market participants are not lacking information. They are lacking a different interpretive framework. They are trained to react to events, not to observe misalignment. To look for shocks, not slow drift. And so, when there is no obvious crisis, they conclude that there is nothing to worry about. But large systems rarely change in noise. They change in silence, when everything still feels stable enough that no one feels compelled to reconsider how they see the world. And that is precisely the part we are usually taught not to look at. Before going deeper, it is necessary to pause for a moment to quickly sketch a map. Not a market map, but a map of how the system is adjusting itself during this period. First is the question of who, not retail investors, not the viewers of this video. The most important adjustments are being made by the actors responsible for maintaining the surface-level stability of the system: central banks, large financial institutions, and entities tasked with managing capital flows. They do not react to daily price movements. They react to pressures that have accumulated over many years. Next is, what is being adjusted? Not a single policy, but three things at once: liquidity, interest rates, and confidence. Liquidity is injected or withdrawn at a slow pace to avoid shock. Interest rates are adjusted not only to control inflation, but to buy time for massive debt structures. And confidence, the most critical factor, is maintained by ensuring that most people still feel the system is functioning normally. So why must this be done now? Because underlying pressures are no longer hypothetical. High public debt, geopolitical tensions, the reversal of globalization, and the rising cost of maintaining the old order. The system cannot resolve everything at once, so it chooses to distribute risk over time. Finally comes the hardest question: who is paying the price? Not immediately, not through a crash, but through the slow erosion of purchasing power, of the ability to save, of the belief that traditional metrics still accurately reflect reality. Those who rely entirely on surface-level indicators are often the last to recognize the change. What is important to understand is this: this is not an emergency response to a crisis. It is a quiet process of recalibrating the system in order to extend its own operating life. And when viewed from that perspective, certain signals begin to become much clearer. At this point, if we stop merely at the feeling that something doesn't quite add up, that is still not enough. To understand why gold and silver are moving the way they are, we need to go deeper into how the system typically reveals its own misalignments. Not through a single signal, but through a sequence of recurring behaviors that have appeared in many previous cycles. This section is not meant to predict the future, it is meant to help you read what the system is saying through its own behavior. First, prices often move before they are allowed to. One of the most common misconceptions among market participants is the belief that prices only react after information has been widely confirmed. In reality, large markets rarely wait for consensus. They respond to pressure before that pressure is formally named. When a structure begins to bear loads beyond normal levels, those who are forced to manage risk will act earlier than those who simply watch headlines. This explains why major rallies often begin amid skepticism and are even labeled wrong for long periods of time. Cycle peaks rarely arrive while people are still arguing. They arrive when almost no one is arguing anymore. Second, cycles end much later than logical expectations suggest. Financial history reveals a rather uncomfortable truth. Major cycles do not end when people understand them, but when the system runs out of capacity to absorb additional pressure. In monetary contexts, this is often tied to interest rates, not because interest rates are the only factor, but because they are the last remaining lever of adjustment. Major peaks in gold and silver in the past have almost never occurred before interest rates truly reached their floor. If interest rates still have room to adjust, then pressure on the system has not been fully released. And when pressure has not been released, defensive measures typically do not stop. Third, the dollar can weaken without collapsing. Another cognitive error is linking rising gold prices to a scenario of total fiat currency collapse. That is not necessary. Throughout most of history, the weakening of a reserve currency has not occurred through a sudden break, but through a gradual loss of its role as the primary unit of value. The dollar does not need to lose its global status to lose relative purchasing power. It only requires that the belief that it is always the least risky option begins to be questioned. When that happens, assets that do not rely on anyone's promise begin to be repriced, not because of panic, but because of reallocation. Fourth, global realities often reach the United States later. One reason many people underestimate current signals is that they view everything through a domestic lens. But when the same assets are compared across different monetary systems, a different picture emerges. In many developed countries, gold and silver have long since surpassed previous highs when measured in local currencies. This does not mean those countries are more correct, but that their cycles have reflected earlier what the United States often delays. History shows that the US is rarely the first to recognize monetary change. It is usually the last, but with a larger adjustment once reality is finally reflected. Fifth, silver does not behave rationally, but it is remarkably consistent. If gold often reflects shifts in confidence at the system level, silver reflects pressure at the structural level. The silver market is much smaller, less liquid, and simultaneously influenced by both industrial and financial demand. This causes silver prices to be highly volatile, sometimes appearing irrational. But when looking back across previous cycles, a familiar pattern emerges. Silver typically moves more slowly than gold in the early stages, and then rises far more aggressively in the later stages. These overshoots are not accidents. They are the consequence of a thin market being forced to adjust rapidly after pressure has accumulated for too long. What do all of these factors have in common? They are not driven by present-day crowd emotion, but by how the system responds when its traditional tools gradually lose effectiveness. The market does not wait for you to believe. It only waits until pressure becomes large enough that it can no longer be ignored. And that is why the current movements in gold and silver should not be understood as a story about speculation. They resemble early signals that a deeper adjustment phase is underway, not over a week or a month, but in the way the system itself is pricing value. At this point in the story, many people tend to arrive at a familiar conclusion. Banks have changed their positioning. They once opposed gold and silver, now they are on their side. That sounds reasonable. But it is a fairly narrow way of framing the issue, and more importantly, it causes us to focus on details rather than structure. The real question is not whether banks are long or short. The more accurate question is, do they still need to convince anyone? In the early stages of a cycle, the system needs to manage expectations. Prices must be kept within acceptable ranges. Signals must remain vague enough that the majority does not feel compelled to act. But once an adjustment phase has progressed far enough, the objective is no longer to control price, but to control speed. Not to block capital flows, but to regulate how they move. This is a crucial distinction. When speed becomes the primary variable, suppressing or supporting prices no longer has long-term strategic meaning. What matters more is ensuring that reallocation occurs in a way that does not shock the system. And in that context, the fact that some large institutions appear less confrontational toward gold and silver is not a sign of changing beliefs, but a sign that they have moved into a different phase of risk management. In other words, the shift is not in positioning, but in permission. When a system no longer attempts to block a movement, it usually means it is preparing to live with that movement. Not because it wants to, but because the cost of resistance has exceeded the benefit. This may sound hard to believe, but history shows that financial systems rarely fight trends until the very last moment. They prefer gradual, quiet adjustment over a direct collision. And when you view current signals through that lens, one thing becomes clearer. This is no longer a story about who is betting where, but about how the system is preparing to adapt to a new reality. Imagine the monetary system as a GPS navigation device. It is designed to help you stay on course, provide clear directions, and make adjustments when there are small deviations. Most of the time, you trust it completely. You do not check a paper map. You do not stop to ask for directions. You simply follow the instructions. The problem does not arise when the GPS shuts off entirely. When that happens, everyone recognizes that something is wrong. The problem arises when the GPS is still functioning, still speaking in the familiar voice, but its underlying coordinates begin to drift slightly. Each individual instruction still sounds reasonable. Every turn appears correct. But after dozens, even hundreds of miles, you realize you are very far from where you intended to go. The monetary system today operates in much the same way. It is not broken. It still processes transactions, still allocates capital, still maintains surface-level order. But the benchmarks it uses to price value, money, interest rates, risk, are gradually losing accuracy. The misalignment is not large enough to trigger alarms, but it is sufficient to accumulate over time. In that context, gold and silver are not destinations. They are more like roadside markers indicating that you are drifting away from the original route. They do not tell you to turn left or right. They simply say, The distance between you and reality is increasing. And when many such markers begin to signal this at the same time, the question is no longer, is the GPS still running? But do you still want to keep driving without checking the map? At this point, one clarification is necessary to avoid misunderstanding. What is being described is not a prophecy of immediate collapse. It is a conditional warning. That is to say, if certain trends continue to converge, the system's response will unfold in ways that are quite familiar from history, even if the form may differ. If capital begins seeking ways to exit familiar structures faster than expected, the system rarely responds with immediate, explicit bans. Crude measures are usually a last resort because they destroy trust faster than any shock. Instead, the more common response is to introduce friction. Not stopping you from moving, but making movement slower, more expensive, and more complex. Friction takes many forms. It can appear as additional procedures, temporary limits, consumer protection justifications, or extra costs explained as necessary to ensure system safety. Each individual measure sounds reasonable, but when stacked together, they alter behavior very effectively, without the need for any clear command. What matters is this. These responses do not arise from malice, but from a logic of self-preservation. A system designed to maintain surface stability will always prioritize controlling the speed of change, rather than stopping change altogether. Because change is unavoidable, only the way it unfolds can be managed. Therefore, the warning here is not panic or act immediately. The warning is, pay attention to how language and mechanisms begin to change. When your ability to use money gradually comes with more conditions, when the cost of converting value quietly increases, that is often a sign that the system is entering a phase where controlling friction becomes the priority. And in such phases, the most dangerous thing is not reacting too quickly, but failing to recognize that the rules of the game are being adjusted little by little right in front of you. When the story is reframed from the system's perspective, action no longer means quick reflexes or rushed decisions. In transitional periods like this, the advantage does not lie in getting one step ahead of the market, but in correctly reading the signals that indicate how the rules of the game are changing. There are 3 particularly important signals to watch, not day by day, but as trends. The first signal is a change in the ability to use money, not in how much money you have. When familiar mechanisms begin to come with more conditions, slower processing, more layers of checks, or restrictions by category of use, that is often an early sign that the system is prioritizing flow management over encouraging free circulation. These changes are rarely heavily advertised, but they directly shape user behavior. The second signal is the widening gap between quoted prices and real-world accessibility. When the spread between paper markets and physical markets grows, or when ancillary costs become more significant than price volatility itself, it suggests that pressure is no longer at the level of valuation, but at the level of allocation. The system may tolerate higher prices, but it does not always tolerate the speed and scale of the accompanying shifts. The third signal lies in policy language. Not the numbers, but how institutions begin to talk about stability, safety, and responsibility. When language shifts from encouragement to management, from expansion to risk control, that is often a sign that a phase prioritizing order has begun to overshadow a phase prioritizing growth. These 3 signals do not require you to do anything immediately. They require you to see clearly. Because in major cycles, those most at risk are not the ones who act slowly, but those who continue to believe that the old rules still apply, even when the signals are saying otherwise. At this stage, the biggest question is probably no longer how far gold or silver might go. The real question is, what are you relying on to guide your financial decisions? If the system is still functioning, if there is no obvious crisis, if everything still looks fine on the surface, then what makes you believe that familiar metrics are still sufficiently accurate? History rarely gives us a clear moment to act. It does not knock on the door and say, now is the time to change. Instead, it presents situations that only in hindsight do we recognize as turning points. Those who struggle the most are often not those lacking information, but those waiting for a signal that is too obvious, a signal that appears only after most of the adjustment has already occurred. So, the question is not whether you believe in a specific scenario. The question is, if the system does not collapse, but quietly transforms, where do you want your money to stand when most people finally realize that old assumptions no longer work the way they once did? And more importantly, which signals are you watching? Prices on a screen or the subtle changes in how the system begins to treat value and your freedom of choice? If you have followed this far, it tells me one thing. You are not looking for a quick forecast, and you do not need someone to tell you what to do. You are trying to understand how the system is operating, and that matters more than any number. This video is not financial advice. It is an invitation to reconsider how we read signals. If you find this approach useful, leave a comment below. Not to agree or disagree, but to share what you are seeing from your own perspective. The best discussions often begin with questions that do not yet have clear answers. If you want to continue exploring this topic, the next video will focus on a very specific question. What does history typically look like after systems enter a phase of still running, but misaligned? Not extreme scenarios, but recurring patterns that are rarely discussed. And if analyses like these help you see more clearly, consider subscribing to the channel. Not to track markets every day, but to keep your thinking ahead of old assumptions.